Ladies and gentlemen, Asian Guy here. It is Wednesday, January 15th, 2026, and at 2 p.m. Eastern Standard Time this afternoon, the Chicago Mercantile Exchange published data that I have never seen in my entire career following silver markets. Data that should be mathematically impossible. Data that proves the paper silver market is not just stressed, not just tight, but completely, catastrophically, irreversibly broken. And I'm going to show you exactly what happened. I'm going to prove it with numbers you can verify yourself. And I'm going to explain why this is the beginning of the end for paper silver. So buckle up, focus, turn off your phone notifications, because what you're about to hear is going to change everything you think you know about the COMEX, about silver, and about what's coming in the next 30 days. Let me start with the numbers, because numbers don't lie. Politicians lie. Wall Street lies. The mainstream media lies. But mathematics is objective truth. Today, Wednesday, January 15th, 2026, was first notice day for the February COMEX silver contract. First notice day is the day when longs, people who are long silver futures, must declare their intention to stand for delivery. They must tell the exchange, I want physical metal, not cash settlement. In a normal market, most traders don't stand for delivery. They're speculators. They're trading the price, not the metal. Historically, 5 to 10% of open interest stands for delivery in a major month like February. That's normal. That's expected. That's how the system is designed to work. In January 2026, which was not a major delivery month, we saw 6,690 contracts stand for delivery. That was already unusual. That was already a warning sign. But today, February, a major delivery month, the number that came in at 2 p.m. was 47,012 contracts standing for delivery. Let me say that again so you understand the magnitude. 47,012 contracts. Each contract represents 5,000 ounces of silver. 47,000, 12 times 5,000 equals 235,060,000 ounces. 235 million ounces of silver are being demanded for physical delivery in February. Now let me show you the supply side. The COMEX publishes daily warehouse reports showing registered inventory. Registered inventory is silver that has been designated as available for delivery against expiring contracts. As of yesterday, Tuesday, January 14th, the most recent report, COMEX registered silver inventory was 23.1 million ounces. Let me repeat that. 23.1 million ounces available. 235 million ounces demanded. The ratio is 10.2 to 1. For every 1 ounce of silver available for delivery, there are 10.2 ounces claimed. This is not a tight market. This is not a supply squeeze. This is mathematical impossibility. The COMEX cannot deliver 235 million ounces when they only have 23 million. It is physically, logically, mathematically impossible. The system is broken. And I'm going to show you exactly what that means. Now, before I go any further, let me put this in historical context so you understand how insane this is. In a normal February delivery month over the past 10 years, the average number of contracts standing for delivery is around 9,000. Some years it's 7,000, some years it's 12,000, but the average is around 9,000. 9,000 contracts times 5,000 ounces equals 45 million ounces demanded. And historically, COMEX registered inventory during February has averaged around 80 to 120 million ounces. So you'd have 45 million demanded against 100 million available. That's a ratio of 0.45 to 1. Less than half an ounce demanded for every ounce available. Comfortable, safe, normal. But today we have 235 million demanded against 23 million available. That's a ratio of 10.2 to 1. This is not 2 times normal. This is not 5 times normal. This is 23 times worse than normal. Let me say that again. The demand to supply ratio today is 23 times worse than historical norms. If you graphed this on a chart, today's number would be off the chart. Literally off the page. It would break the scale. And this is happening on first notice day, which means the COMEX has from now until the end of February to somehow deliver 235 million ounces when they only have 23 million. How are they going to do that? The answer is they're not. They cannot. The math does not work. The system has reached the breaking point. And everyone in the silver market, from the biggest banks to the smallest retail traders, everyone just saw this data at 2 p.m. today. And everyone is asking the same question, what happens now? Now let me explain why this is impossible and why the normal mechanisms that should fix this cannot work. In a functioning market, when demand exceeds supply, the price rises until supply increases or demand falls. That is Econ 101. So if the COMEX has 235 million ounces demanded and only 23 million available, the price should rise until either some longs decide to cash settle instead of taking delivery, or additional silver holders decide to convert their eligible inventory to registered and make it available for delivery. That's how it's supposed to work. But here's the problem. It's not working. The price has already gone from $85 on January 1st to $91 today. That's a 7% increase in 2 weeks. And the demand didn't fall, it accelerated. 47,000 contracts stood for delivery. That's the highest number in comics history for a February contract. So price increases are not reducing demand. Why? Because the buyers standing for delivery are not speculators. They're not retail traders who get scared by volatility. They're industrial users. They're manufacturers who need physical silver to keep their factories running. They're sovereign wealth funds diversifying reserves. They're smart money institutions who understand that paper silver is fake and physical silver is scarce. These buyers don't care if the price is 91 or 100 or 120. They need the metal. They will pay whatever it costs. So demand is inelastic. Price increases don't reduce it. What about supply? Why don't holders of eligible inventory convert to registered and make it available? Because they don't trust that they'll get it back. Eligible inventory is silver sitting in COMEX warehouses, but not designated for delivery. The owner has the silver stored there for convenience, but they haven't made it available to satisfy contracts. If they convert to registered, they make it available. But here's the risk. Once it's registered, the COMEX can allocate it to satisfy deliveries. And in a shortage, once that silver is allocated and delivered to someone else, it's gone. The original owner might not get it back. So holders of eligible are refusing to convert. They're saying, I have my silver sitting in the warehouse. It's mine. I'm not making it available to bail out the shorts. As a result, eligible to registered conversions have been minimal. Over the past 2 weeks, only 3 million ounces converted from eligible to registered. 3 million, that's nothing. That barely dents the 212 million ounce shortfall. So the normal market mechanisms, price increases and inventory conversions, are not working. The system is stuck. Demand is inelastic. Supply is frozen. And the gap between the two is not closing, it's widening. Now let me show you why the arbitrage is dead. And this is the most important thing you need to understand about what's happening right now. In a normal commodity market, when there's a supply shortage in one location, arbitrage traders buy the commodity elsewhere and ship it to where it's needed. If New York has a shortage and Shanghai has a surplus, traders buy in Shanghai, ship to New York, and sell for a profit. The arbitrage closes the gap, but in the silver market right now, the arbitrage is dead. Not difficult, not expensive, dead. And there are 3 reasons why. First, there's no silver in Shanghai to buy and ship west. Shanghai is not in surplus. Shanghai is in deficit. Shanghai is trading at $104 per ounce while COMEX is at 91. That's a $13 premium. When Shanghai trades at a premium, it means Shanghai is short silver too. Chinese industrial buyers, solar panel manufacturers, electronics companies, EV battery makers, they're all competing for limited supply. And the Chinese government imposed export restrictions on January 1st. If you get silver into China, you can't get it back out without an export license. And China is not issuing licenses, so Shanghai silver is trapped inside China. You can't arbitrage it to New York. Second, even if you could source silver elsewhere, shipping physical metal takes time. It takes 4 to 6 weeks to ship 1,000-ounce bars from London to New York or from Dubai to New York. You have to arrange the logistics, get the metal out of one vault, put it on a plane or ship, clear customs, get it into a COMEX-approved warehouse, and get it certified as good delivery. That whole process is 4 to 6 weeks minimum. But the February delivery period starts in 10 days and ends in 28 days. There's not enough time to source metal from overseas and ship it to COMEX to satisfy February deliveries. The deadline is too close. Third, the bullion banks who are short and would normally be the ones doing the arbitrage, they're paralyzed. They don't want to buy silver. Buying silver to deliver against their shorts means realizing their losses. If they're short at $60 and they have to buy at $91 to deliver, they lose $31 per ounce. They're desperately hoping the price comes down so they can cover cheaper. But the price isn't coming down. It's going up. So they're frozen. They're not buying. They're not arbitraging. They're just sitting there hoping something changes. But nothing is changing. The demand is 235 million ounces. The supply is 23 million. The math is broken. And the arbitrage that should fix it is dead. So what does this prove? What does it mean that 47,000 contracts stood for delivery when the COMEX can only deliver 4,700? It proves that we now have 2 separate silver markets. Market A is the paper market. That's the COMEX futures market where silver trades at $91. This is the market for people who want price exposure, who want to speculate, who want to trade contracts. But it's increasingly clear that these contracts are not backed by physical metal. They're just paper promises. IOUs, bets on a price. Market B is the physical market. That's the market where real silver changes hands. And in the physical market, prices are much higher. Shanghai is 104. India is 132. US retail silver eagles are 142. These are the prices people pay when they want actual metal, not paper. Which price is real? The physical price. The paper price is a fiction. It's a number on a screen created by traders buying and selling contracts that will never result in delivery. And the 47,000 contracts standing for delivery today are proof that the fiction is collapsing. Because those 47,000 contracts represent buyers who are calling the COMEX's bluff. They're saying, you sold me a contract that promises 5,000 ounces of silver. I want my silver, deliver it. And the COMEX is looking at its vaults and realizing we don't have it. This is the death of the paper market. When contracts can't be delivered, when promises can't be kept, the contract becomes worthless. And that's what's happening right now. The paper market is being exposed as a fraud. A Ponzi scheme where the exchange sold more claims on silver than silver actually exists. And now the claims are being called. And the scheme is collapsing. Now let me tell you what happened over the past 2 weeks that makes today's number even more shocking. 2 weeks ago, on January 1st, the COMEX tried to stop the silver rally. They raised margin requirements by 15%. They changed the margin calculation from a fixed dollar amount to 9% of notional value. This was designed to force traders to liquidate. When you raise margin requirements, traders who are leveraged, who borrowed money to buy contracts, they have to either post more cash or sell their positions. The COMEX was hoping that raising margins would trigger a wave of selling that would bring the price down and reduce delivery demand. For about 48 hours, it looked like it might work. The price dipped from 88 to 85. Some traders got margin calls. Some sold. There was pressure. But then something happened. The buyers came back, and they came back harder. Because the buyers standing for delivery are not leveraged speculators who can be shaken out by margin hikes. They're cash buyers. They're institutions. They're industrials. They don't care about margin requirements because they're not using leverage. They have the cash. They're fully funded. They want the metal. So the margin hike failed. The price rebounded from 85 to 91. And a delivery demand, instead of falling, exploded to 47,000 contracts. The manipulation failed. The attempt to suppress demand failed. The attempt to protect the shorts failed. And now the COMEX is facing a delivery crisis with no tools left. They already played the margin card. It didn't work. What's next? Trading halt? Force majeure? Cash settlement? Because they're running out of options. And the shorts, the banks, who are on the other side of these 47,000 contracts, they're in serious, serious trouble. Let me explain why the banks are trapped and why today's data is their nightmare. The major bullion banks, JP Morgan, HSBC, Scotiabank, they have been net short silver for years. This is documented. These banks are the ones who sold the contracts that are now standing for delivery. When you're short a futures contract, you have an obligation to deliver the underlying commodity if the long stands for delivery. So right now, those banks collectively owe 235 million ounces of silver to the longs who stood for delivery. But they don't have 235 million ounces, not even close. They were counting on most longs not standing for delivery. They were counting on most contracts being cash settled. They were counting on the system working the way it always has. But today proved that the system is not working. 47,000 contracts stood. That's 47% of open interest. Historically, it's 5 to 10%. Today was 9 times historical norms. The banks are trapped because now they have 2 choices. Choice 1, find 235 million ounces of physical silver and deliver it. Where are they going to get it? COMEX only has 23 million registered. They'd need to source 212 million ounces from somewhere else. From miners? Mining companies have already sold forward most of their 2026 production. From refiners? Refiners are quoting 8-week lead times. From overseas? Shanghai is in shortage and not exporting. From private holders? Private holders are not selling. They know silver is scarce. They're holding for higher prices. So the banks can't source the metal. Choice 2, declare force majeure. This is a legal mechanism where the exchange declares that delivery is impossible due to circumstances beyond their control. The exchange cash settles the contracts at a price they determine. Longs get cash instead of metal. But if the COMEX declares force majeure, it's an admission that the paper market is a fraud. It destroys confidence. It confirms that COMEX contracts are not backed by real silver. The price of physical silver would explode. Shanghai, India, retail markets would gap to 150, 180, 200, and every future delivery month would face the same crisis because no one would trust COMEX contracts anymore. So the banks are stuck between 2 impossible choices: deliver metal they don't have, or declare force majeure and destroy the paper market. Either way, they lose. Either way, this is catastrophic. And the longer they wait to decide, the worse it gets. Because every day, more silver leaves the COMEX system. Every day the registered inventory drops. Yesterday it was 23 million. A week ago it was 27 million. It's bleeding, and when it hits zero, the decision is made for them. Force majeure becomes inevitable. Now let me show you what's happening in other markets, because silver is not isolated. This is part of a global crisis in commodity markets and paper assets. Gold just made a new all-time high, $26.44 per ounce. That's up 42% from the start of 2025. Gold is screaming at the world that there's a crisis in fiat currency. When gold goes vertical, it's a vote of no confidence in central banks and paper money. U.S. Treasury yields are spiking. The 10-year Treasury yield hit 4.71% today. That's up from 3.8% in December. What does that mean? It means bond prices are falling. Investors are selling U.S. government bonds. They're dumping treasuries. Why? Because they don't trust the U.S. dollar. They don't trust the government's ability to service its $36 trillion in debt. They're fleeing paper and buying hard assets. The stock market is in turmoil. The S&P 500 is down 14% from its November highs. Technology stocks are getting hammered. Why? Because companies that need commodities, silver, copper, lithium, rare earths, their costs are exploding, their margins are compressing. Tesla just announced a production halt because they can't source enough silver. Apple delayed the iPhone 18 launch because of component shortages. These are real-world impacts. Commodity shortages are crashing equity valuations. And the Federal Reserve is trapped. They can't raise interest rates to support the dollar because that would crash the economy. They can't lower rates to stimulate growth because that would spike inflation even higher. There's no good move. They're in zugzwang. And the smart money sees it, which is why gold is $26.44, which is why silver is $104 in Shanghai, which is why treasuries are being sold. This is a systemic crisis. And the 47,000 contracts standing for COMEX delivery today are just one symptom of the broader collapse of confidence in paper assets. Let me show you what's happening in India, because India confirms that this is a global physical shortage, not just a COMEX problem. India is the world's largest consumer of physical silver. Indians buy silver for jewelry, for weddings, for religious ceremonies, for savings. It's cultural. It's embedded in Indian society. And right now, the Indian silver market is in absolute panic. The local price in India has shattered through 300,000 rupees per kilogram. That converts to approximately $136 per ounce. 136. When COMEX paper says 91, India physical is 136. That's a $45 premium. That's a 49% premium. And at 136, the market is sold out. Major bullion dealers in Mumbai, Delhi, Hyderabad, they're showing out of stock on their websites. When you call them, they tell you, maybe next month, maybe. Refineries have stopped taking orders. They're telling customers, we don't know when we'll have supply. This is not a price issue. This is an availability issue. Indians would pay $136, $150, $180 if metal was available, but it's not. The physical silver is gone, and Indians are panicking. They're converting gold jewelry to buy silver. They're taking loans to buy silver. They're doing whatever it takes, because Indians have thousands of years of experience with currency collapse. They know what happens when fiat money dies. They know the value of hard assets, and they're not going to be caught holding paper. So they're paying $136 per ounce in India. They're paying $104 in Shanghai. They're paying $142 for U.S. retail coins. These are the real prices. These are what people pay when they need actual metal. And the gap between these prices and the COMEX paper price of 91 is proof that the paper market is a lie. COMEX says 91, but you can't buy physical silver anywhere in the world for 91. Not in Asia, not in India, not in the U.S. retail market, not anywhere, which means 91 is not the real price. It's a fictional price for fictional paper contracts that can't be delivered. So what does this mean for you? What should you do right now? Let me be extremely clear, because the next 30 days are going to be chaotic. If you own physical silver, bars, coins, rounds in your possession, in a safe, in allocated storage, do not sell. Do not even think about selling. You're sitting on the winning hand. The COMEX just proved they cannot deliver. 47,000 contracts stood for delivery. They only have 23 million ounces. They're short 212 million ounces. This is the end of the paper market. This is the moment when physical and paper diverge permanently. The paper price might stay at 91 or even dip to 85 if the COMEX manipulates it lower. But the physical price is going to 120, 150, 180. And you own physical. You own the real thing, not paper promises. Real metal. Hold it. Guard it. Don't let anyone talk you into selling. Because in 3 months, when physical silver is trading at 160 and the COMEX has declared force majeure and paper contracts are worthless, you're going to be very glad you held. If you own silver ETFs like SLV, you are in danger. SLV is custodied by JP Morgan. JP Morgan is one of the biggest shorts. Do you think JP Morgan actually has all the silver that SLV claims to hold? Or do you think maybe they hypothecated it, lent it out, pledged it to multiple parties? Today's data shows 47,000 contracts standing for delivery against 23 million ounces available. That's a 10-to-1 ratio of claims to metal. Do you think SLV is any different? I think SLV has sold more shares than they have silver backing. And when push comes to shove, when people try to redeem SLV shares for metal, JP Morgan is going to say, sorry, we don't have it. Here's cash. You'll get $91 per ounce in cash while physical trades at $160. You'll lose $69 per ounce because you trusted paper. Don't do that. Sell SLV, take the cash, buy physical metal, do it this week. If you own COMEX silver futures and you were planning to stand for delivery, I have bad news. You might not get your silver. Today's data shows the COMEX is short 212 million ounces. They cannot deliver. They're going to have to declare force majeure or invoke some emergency clause that lets them cash settle your contract. You wanted 5,000 ounces of silver? They're going to give you a check for $455,000. That's 5,000 ounces times $91. But on the day they cash settle you, physical silver is trading at $120. Your 5,000 ounces should have been worth $600,000. They just stole $145,000 from you. And it's legal. It's in the contract terms. They have the right to cash settle under force majeure. So if you're holding COMEX futures for physical delivery, you need to decide right now. Do you close your position, take your profit, and buy physical from a dealer? Or do you risk getting cash settled at 91 when physical is worth 120 or more? I know what I would do. Close the futures. Take the cash. Buy physical. Do it before the COMEX announces force majeure. Because once they announce, your futures are frozen and you're stuck with whatever settlement price they dictate. If you don't own any silver and you're thinking about buying, the question is not should you buy. The question is, can you still buy? Because the physical market is disappearing. The COMEX just proved they don't have the metal. 47,000 contracts stood for delivery. They only have enough metal to satisfy 4,700. What do you think happens to the other 42,300 contracts? Those people are going to go to the retail market to buy physical. They're going to call APMEX, JM Bullion, SD Bullion. They're going to clean out whatever inventory is left. The dealers are already sold out or charging huge premiums. U.S. Mint stopped selling Eagles, retail is thin, and 42,000 contracts worth of disappointed COMEX longs are about to flood the retail market. You need to buy now. Today, call a dealer. Buy whatever they have in stock. Pay the premium. Get the ounces. Because next week, there might not be any left. Now let me tell you what happens next, because everyone wants to know the timeline. When does the COMEX declare force majeure? When does the paper market break? I don't have a crystal ball, but I can tell you the pattern based on today's data and historical precedent. Here's what I think happens. Over the next 7 days, the COMEX is going to scramble. They're going to beg holders of eligible inventory to convert to registered. They're going to offer premiums. We'll pay you 93 when spot is 91 if you make your silver available. Some holders will accept. Maybe they'll get another 10 or 15 million ounces converted. That brings registered from 23 million to 38 million. But they still need 235 million. They're still short 197 million. So around January 22nd, 1 week from now, the COMEX is going to issue a statement. Something like, due to extraordinary demand for physical delivery and ongoing supply constraints, CME is evaluating all available options to ensure orderly settlement of the February silver contract. That's code for, we're preparing for force majeure. The market will freak out. Silver will gap up. Paper might go from 91 to 105 overnight. Shanghai will go from 104 to 120. Everyone will realize the COMEX is in crisis. Then, around January 30th, 10 days before the end of February delivery, the COMEX will make the announcement. In accordance with Rule XYZ of the CME rulebook, the exchange is implementing alternative settlement procedures for the February 2026 silver contract. All contracts will be cash settled at a settlement price of, and they'll pick a number, probably 95 or 100, effective immediately. Physical delivery is suspended for February. That's the force majeure. That's the moment the paper market dies. And when that happens, the physical market will explode. Shanghai will gap to 130. India will gap to 160. U.S. retail will be completely sold out. You won't be able to buy an ounce at any price. And the COMEX paper price will crash. It'll drop from 91 to 75 or 60 because everyone will realize COMEX silver is not real silver. It's just a cash-settled bet. No one will want it. The premium on physical versus paper will be $40, $50, $60. We'll have two completely separate markets. And if you're holding physical, you win. If you're holding paper, you lose. That's the timeline. 7 days of scrambling, 10 days of warning statements, 30 days until force majeure, and then the permanent bifurcation of the silver market. Let me give you one final piece of data that confirms this is the end. The 47,000 contracts standing for delivery today represents 47% of the open interest in the February contract. 47%. Historically, 5 to 10% stand. Today was 9 times normal. Why? Because smart money knows the COMEX is about to break. They're front-running the force majeure. They're saying, I want my silver now before the system collapses. This is a bank run. You know how a bank run works? A bank loans out 90% of its deposits. They keep 10% in reserve. Normally, only 5% of depositors withdraw at any given time. The bank is fine, but if 20% of depositors show up at once demanding their money, the bank can't pay. They don't have it. That's a bank run. And today was a COMEX bank run. 47% of contract holders showed up demanding their silver. The COMEX only has 10%. They can't deliver. The run has started. And bank runs don't stop. They accelerate. Next month, March, 50% will stand for delivery, then 60%, then 80%, until the COMEX shuts down physical delivery entirely. This is the end. This is not a squeeze that releases. This is not a temporary tightness. This is structural failure. The COMEX sold more claims on silver than silver exists. They ran a fractional reserve commodity market, and today the depositors showed up. And the vault is empty. Game over. So here's my final message to you. The 47,000 contracts standing for delivery today is not just a big number. It's not just unusual. It's proof, mathematical proof, that the COMEX does not have the silver to back the paper contracts they sold. It's proof that the paper market is a fraud. It's proof that physical silver is in severe shortage. It's proof that the banks are trapped with no way out. And it's your last chance to get out of paper and into physical before the system collapses. Do not wait for Bloomberg to tell you. Do not wait for Jim Cramer to give you permission. Do not wait for the COMEX to officially announce force majeure. By then, it's too late. Physical will be unavailable, paper will be worthless, and you'll have missed the greatest wealth transfer in commodity market history. This is your name. It is Wednesday, January 15th, 2026. 47,000 contracts stood for delivery. The COMEX only has 23 million ounces. The math is broken. The ratio is 10 to 1. The banks are trapped. The system is collapsing. And you need to decide right now, are you holding physical metal or paper promises? Because in 30 days, the difference will determine whether you're rich or broke. Get out of paper. Get into physical. Do it now. Do it today. Do it this hour. Call your dealer. Place your order. Pay the premium. Get the metal. This is Bullion Watch. Remember to like, subscribe, and share this video with everyone you know who owns silver. They need to see this data. The COMEX is broken. The delivery crisis is here. The endgame has begun. Get out of paper. Get into physical.